In my previous real estate company, our basic business model was to redevelop underperforming properties, mostly using flexible leasing. We operated in a small Canadian market, and our sweet spot was mid-sized properties, buildings too large for dentists looking to dabble in real estate, but too small to catch the attention of the national REITs. The returns were great, and we had virtually no competition. But unfortunately, our size and location gave us few options when it came to valuations. One common valuation issue was something I call the circular reference, named after the spreadsheet error message that appears when accidental loops are created in formulas. Valuations using the income approach use a simple formula, which includes a property's income and a capitalization or discount rate. To determine the capitalization rate, valuers look to past sales and reverse the formula, using the known sale prices and incomes of comparable properties. Because these capitalization rates are based on past sales, they have all of an investor's expectations baked into them. It's called an all-risk rate because it includes investors' expectations on future rental rates, tenant creditworthiness, returns, and even the eventual sale price, indirectly embedded into one number. To determine a subject property's worth, valuers look through a pool of comparable historical sales and apply the implied capitalization rate to the subject property. A valuer may make small tweaks to the rate to account for differences in the quality of the income, but the value is largely determined by the past sales. Since real estate is just one option in a larger universe of investment choices, capitalization rates should track as a premium over the risk-free rate, which is usually the 10-year bond yield. It's a great shortcut for determining value in the same way that a stock price reflects investors' expectations of the future. Pepsi trades at about 26 times earnings, so it's no surprise that Coca-Cola trades at 28 times earnings. Capitalization rates are the equivalent of those price multiples. However, some assumptions, while true in the stock and bond markets, don't translate as well to real estate. Real estate is not as active of a marketplace. It has slow closing times, and it does not provide homogeneous investment choices. For the past 15 years, in my local market, capitalization rates always hovered around the same rate, regardless of bond yields. Capitalization rates were so predictable that I developed a sort of magic trick I could use to impress landlords. They would tell me the size of their property, and I could instantly tell them their last valuation amount. All I had to do was multiply the size by 200. Our market had so few transactions that the traditional valuation method was stuck in a circular reference. Most real estate investors use debt, and the last thing a lender wants is a default. They don't want to own the property. Lenders design their requirements to minimize their costs in the event of a default. In our market, a common practice was to lend a maximum of 70% of either the value or the purchase price, whichever is lower. Valuations are built using comparable sales data, but to count as a comparable sale, there has to be an actual sale. So by definition, the data points being used are from the past. Real estate has a long transaction time, so the past sale price was negotiated even further in the past. The less active the market, the older the comparable sales. Once the valuation is complete, the buyer and seller of the property are boxed in. A buyer is unlikely to purchase a property above the valuation amount since any price paid over the valuation can't be financed. Other buyers face the same dilemma. So unless the buyer is highly motivated and cash rich, the sale price will be adjusted to the valuation. In other words, the sale price has been dictated by the valuation. Compounding the problem, the sale is then fed into the pool of comparable sale prices. Sale prices are a function of valuations, which are a function of sale prices. It's a circular reference, but unlike Excel, no one receives an error message. What seems to be a small market problem could be making its way into bigger cities, especially as space-as-a-service models gain traction. The traditional valuation model relies on comparable properties being very similar, so only minor tweaks in the capitalization or discount rate are needed. Only small adjustments are needed to compare a 7-year lease with Google against a 9-year lease with Microsoft, since both are unlikely to default and they essentially have the same risk profile. It's Coke versus Pepsi. But a landlord with an 8-year lease with WeWork has a far different risk-return profile than another landlord who has a partnership agreement with Newflex. Even if the valuer had the details of the lease and the partnership agreement, would they know how each agreement is performing? As space as a service continues to grow, properties that were once comparable will become even less homogeneous. Levels of service will become more diverse and the delivery models more distinctive. Even in large markets, the pool of comparable properties will shrink, increasing the probability of getting stuck in a circular reference. I believe the solution is to use the risk-adjusted method, the modern valuation tool used in other industries. Rather than tweaking the capitalization or discount rates, which rely on having the appropriate comparables, the risk-adjusted method puts a larger focus on predicting the subject market's income, which is where the risk actually resides. Unfortunately, as long as we continue to use methods involving comparable property discount rates, we risk being stuck in circular references. And with space as a service becoming a larger component of the market, the pool of relevant comparables will shrink. Given the dynamics of many real estate markets, valuers are unintentionally dictating value rather than simply reflecting it. Hopefully this video has been useful and will spur some discussion around the future of office space. I had great conversations with people over LinkedIn after doing my last video. If you have any thoughts on this or anything in commercial real estate, connect with me over there.